Factoring accounts receivable. Sometimes merchants or companies will want to accelerate their cash collections by factoring or selling their accounts receivable. The following is a diagram that shows the factoring process. Factors are essentially finance companies or banks that buy receivables from a business for a fee. The steps are as follows. First, our customer still places an order with the company, but now the company will request a credit review from the factor because the factor ultimately will collect the receivables. The factor is going to approve the credit request or not approve it. If it approves the credit request, it will advance the cash for the sale to the company. The company will ship the goods to the customer. And finally, step number 6, the customer eventually will make payment to the factor in the 30, 45, or 60 days, or whatever credit terms have been granted to the factor or to the customer. We're going to take a look at some of the issues and journal entries associated with recording the factoring of receivables on the part of a merchant and the finance company. But first, let's consider some background information. If a company sold land that had a book value of $200,000 for $190,000 in cash, it would record the following entry. First, it's going to record the $190,000 increase in cash on its books, and it will take the land off its books for $200,000. Since debits don't equal credits, obviously we need an additional $10,000 debit, which will be a loss on the sale. The journal entry is essentially the same if instead of selling land, we were to sell our accounts receivable. Instead of crediting land for $200,000, we would credit accounts receivable for $200,000, but we would still have the same $10,000 loss on the sale. In this case, however, we can almost consider the loss on the sale essentially a finance charge that we've received, or rather have paid, for accelerating the collection of our cash. The buyer or finance company will in fact record the financing revenues of $10,000. They will decrease their cash by $190,000, record an asset and accounts receivable of $200,000, and the difference will be the financing revenues. Let's go ahead and take a look at some additional issues. First, the buyer or finance company is concerned about collecting the purchased receivables. Is the $200,000 really worth $200,000? One, the customer might return merchandise to the merchant and thus not pay the receivable. Or two, the customer might actually default on the receivables. In other words, there could be bad debt expense. Let's first consider potential customer returns. In anticipation of potential customer returns, a factor will hold back a portion of the purchase price. If estimated allowances are, say, $15,000, in other words, we expect $15,000 in customer returns, the merchant will only receive $175,000 in cash today. Our original journal entry showed the receipt of $190,000 in cash, but now we will only receive $175,000. And again, since debits don't equal credits, we need an additional debit of $15,000. This will be a due from factor, or a receivable on the merchant's books. And if customers don't return any merchandise, the merchant will ultimately collect that $15,000 from the factor or finance company. On the factor's books, the entry will change as follows. The $190,000 in cash again becomes $175,000 in cash. They will record a liability due to merchant of $15,000. Let's go ahead and take a look at subsequent returns by customers. Normally, a merchant would record a customer return as follows. They would debit sales returns for $500 and credit accounts receivable for $500. But now, since the merchant no longer carries the receivable on its books, it will instead credit the account due from factor for $500. In other words, this is $500 less that the finance company will owe us down the road. If out of that $15,000 in estimated customer returns, subsequent returns turn out to be $12,300, the merchant would record sales returns of $12,300. It would receive an additional $2,700 more in cash from the factor or finance company, and it would credit the amount due from factor for the full $15,000. The finance company would make the following entry. It would take the $12,300 in receivables off its books because it would no longer be able to collect that amount from the customer. It would credit cash for $2,700 as it sent the merchant an additional $2,700 in cash, and it would take the full liability due to merchant of $15,000 off of its books. Now let's consider potential customer defaults. How customer defaults or potential non-payment is handled depends on the terms of the factoring agreement. Are the receivables factored on a recourse or a non-recourse basis? If the sale is on a non-recourse basis, the purchaser or the finance company assumes the risk of collection. The transfer is an outright sale of receivables. The seller records a loss on the sale, and the seller uses a due from factor receivable account to cover discount returns or other potential allowances. That's the case we have just finished looking at. If, however, the sale is on a recourse basis, the seller will record an estimated recourse liability and a larger loss on the sale. Let's assume the sale is on a recourse basis with an estimated $6,000 recourse liability. Here was our original journal entry for a sale on a non-recourse basis. We had the $15,000 due from factor. That was for a potential customer's returns of merchandise. We had the loss on sale of $10,000. That was essentially our finance charge. We received $175,000 cash, and of course we took the $200,000 accounts receivable off of our books. If we have a $6,000 estimated recourse liability, we need to record that estimated liability on our books. And so we'll do that with a credit to recourse liability for $6,000. And since obviously our debits no longer equal our credits, we need an additional $6,000 debit. And we will increase the loss on sale from $10,000 to $16,000. So again, it's a simple change to go from a non-recourse to a recourse basis. We add the estimated recourse liability, and then we increase the loss on the sale for the amount of the recourse liability.